Hi everyone, and welcome back to another simple daily practice drill that you can use to become a better trader. And this one is about spikes and stops. So let's go and check it out. So in previous videos, I've done two things. One, over here, we talked about spikes, and over here, we talked about stop entries. Now, what if you were to combine both of them together to help you take high probability entries? Well, that's what this video is about. So the first part of the drill is to look at the chart and look and see where these low ones are. The second part of the drill is to look at where these fail. And the third part of the drill is going to be to look at where they fail and see if it becomes a test target for later on. So let's jump into it. Now, if you're using TradingView, there's a free TradingView indicator that's going to highlight 3 consecutive bars. Otherwise, it's pretty easy just to draw it on your chart. Here are the 3 consecutive bars. Now I'm going to add the stop entries. Now I've put the 3 circles on the chart so it's a little bit easier to see, if you're on the mobile. These are the 3 entries I want you to look at. On this day, we get 3 consecutive bear bars. We're in a bear spike already, but 3 consecutive bars, and we're waiting for a good bear signal bar to enter, and this is going to be our signal bar. So that's the spike and the first stop entry. Now, a good sign of a breakout trade is that your entry creates a new spike, and what we're going to see is new spike, new stop entry here. Does it trigger? That triggers as well. Now the stop is probably up here somewhere. Does the stop get run? Okay, now it's setting up a potential second entry, and that's the second entry for the spike. Okay, and we get a new low. So we had one spike, here's another spike with a stop entry. You end up creating a second one, or we get a new low. Now we know on this day it reversed back, but you can see how important it is once the market triggers those signals for it to go and test. Okay, now what's happening here? Now we've got a bull spike. So bulls are now waiting for a buy signal. That's an inside bar, so a lot of traders will wait. Now traders are going to buy one tick above that bar. We're going to get a new bear spike here. Yeah, it looks like a new bear spike. So we need to pull back. There's a pullback, new high, or we're going to go down. Okay, that's not a good signal bar to short. Okay, so still going sideways. Okay, so now we're on to the next day. So even though there can be multiple spikes and multiple stop entries, it's that first one that I think traders should be really looking to take early on in the day. That's the first spike entry. Now, if those spike entries are going to fail instantly, well, you end up taking a loss. But now it's probably going to be a trading range. As long as spike, pullback, high ones are working, then that spike's more likely to create a channel than not. A trading range usually forms when an up spike fails and then the down spike fails. And now in between those 2 losing entries, price goes back and forth. Let's have a look at some more charts. This chart's interesting because we had a bear spike but no signal bar, a bull spike but we got no buy signal bar. Then we got a bear spike and we got a bear signal bar. Now, some traders might have taken this one. Here's a bear signal bar. Let's say you sell there with a stop above the high. Did you get stopped out? No, it looks like you were okay. The high there's 93.50. The high there's 93.50. So you're still in by 1 tick. So bears are still in control. Now you've got a new bear spike. And where's the next sell signal? Well, it's a bit difficult in here. It's not until this bear spike you get another sell signal, but now you're having multiple spikes and you're not getting strong sell signals. And that's a warning to say that this might not be a very strong trend. In fact, it's probably more going to operate like a channel. Instead of breaking out and creating new spikes in that direction, this is going to form one half of a trading range, which is then going to go back up the other way. What about here? Spike, good signal bar, spike, and then no good signal bar. You can see the indicators looking for a really strong signal bar, but traders took weaker signal bars in here, betting that there are enough bars to get a signal up. What about here? Here's a strong spike. There's the signal bar. Oh no, it failed. And now you've got an opposite spike. Okay, so you're holding a losing position. Now you're looking for a buy signal bar to get filled. There's your buy signal. That was a new spike and channel. Spike down, that's an inside bar. There's your new signal. So once you start to look at a few charts in this way, one of the things you might begin to notice is that by the time the indicator tells you to get in the trade, that's the end of the move. Well, that's pretty useless. How come it's lighting up at the end and not the start? Well, that's where leg counting becomes very useful. And I've got a video on leg counting that you can go and watch, which is going to help you do that. If you go back to the first spike video that I showed, in that video, we talked about spikes being strong at the start and the end. And it was that ending spike that you've got to watch. Let's have a look at this day. You can see here, the market's been in a bear channel. We have a really strong leg down, probably one leg in there, or at least one, and then a second leg. And so if you're seeing the spike as the second leg, you've got to be really careful trading that small leg. You're hoping leg 3 is going to be a big leg down here. But by the time you see these bars here, you've got to be thinking to yourself, that might be the end. So if you take a small loss there, because remember your stop's all the way up here. So you're only taking a small loss. Now you got a new spike. Great. I'm flat to participate. And then I've got buy signals, 3 bull bars above the moving average. Good looking buy signal, buy, hold until you have a couple of reversals. And then the same on the way down here. Spike, 1, 2, 3, 4, 5, 6, 7 bars down. Signal bar was an inside bar. Sell. Now you're back down at the low of the day. And interestingly enough, that's where traders took that losing signal. Now, this is similar to a few of my other drills where you look and see for a high probability signal that fails, and that becomes a trade in the opposite direction. So if you took a loss on this short here, you got long somewhere in here and made it all back, but you're not going to then sell again back at that same place that you took a loss. In the previous video about spikes, we looked at counter-trend spikes. So we're in a bull channel, but there is a bear spike that's being lit up, 3 consecutive bars. Now, what happens if you get a pullback of 3 consecutive bear bars, which then creates a low one sell? Should I sell there above the moving average? In general, I'd say no. If we're in a bull spiking channel, and it's probably better to wait for the next buy signal. Now let's have a look at some of these examples. In this example, you can see we've got a big gap up, bear bars, and then many bull bars to a new high of the day. So in this example, are you waiting for a sell signal to go short? Well, because it's such a tight bull channel and we're above the moving average, it's probably better to wait for a second leg and look for a buy signal. So there's the potential low one sell that everyone wants to take. But what happened? It doesn't trigger. And that's interesting because if you're short or you're waiting to sell and now you've got consecutive bull bars above the moving average, some traders are going to start buying and scaling into buys at the moving average. Now you've got a bull spike. So now you're looking for the high one buy. Bull spike, you need a pullback and you'll be looking for a buy signal in here. Small bull bar, does it trigger? Okay, with tails, traders are waiting. Maybe it's a second leg sideways to down, but at some point, traders are going to start buying above these. Now, it might be above that bar or it might be after a pullback. Okay, we never triggered above that bar, so not yet. If we go one tick above that bar, that's going to be the buy signal. Okay. So now traders are long. This is a really good way, I think, to look at market structure. So now you've got a couple of different exercises in this drill. One is to mark up the spikes with the stop entries. That's one. 2, it's to look at, do the entries trigger or not? Then I want you to look at, does that high probability entry fail? And if so, is that because it's a late leg? Then I want you to look at, if it does fail, does it come back and test? And then finally, I want you to look at counter trend spikes and their relationship to set up trades in the new direction. Hey, thanks very much for watching. I hope you found that video interesting. My name's Tim Fairweather from Zen Trading Tech. See you in the next video.